I never just look at the price tag on a stock. Here's the number that made me stop. There's a tool that turns "is $10 cheap" into an actual answer, one you calculate before you buy, not after the fact. For years, I didn't have that tool. Someone would tell me a stock was cheap, and I just believed the price. $10 sounded cheap. $100 sounded expensive. That was basically my entire strategy. I'm not the only one who thought that way, because buy low, sell high is the one piece of investing advice literally everyone repeats and almost nobody defines. Low compared to what? A $10 share and a $100 share can be the exact same deal, or one of them can be a total ripoff, and the sticker price alone will never tell you which. There's no crystal ball for the perfect moment to buy, but by the end of this, you'll never look at a price tag the same way again. Here's why this actually matters, and it's not abstract. My dad has been giving me the same stock advice since I was 22. Just buy it when it's low. He said it about actual paper stock certificates once, and I don't think he's updated the strategy since. And the annoying part is, he's not wrong exactly. He's just repeating a rule that only works if you already know what low means, which, for most of us, we don't. So we do one of two things. Either we freeze, watching a stock we're interested in for months, waiting for some invisible signal that never comes, and we never actually invest. Or we do the opposite, an even more expensive thing. We see a stock that dropped 20% and assume it's automatically a deal, when really the price fell for a reason that's about to keep costing us money. Both of those cost you. The freezing costs you years of compounding you never got, sitting in cash while the market moves without you. The false bargain move costs you actual dollars, buying into a business that keeps getting cheaper because it deserves to. I've watched people, smart people, do both in the same year on the same portfolio, because nobody ever taught them how to tell the difference between a stock that's actually cheap and one that just looks cheap. Here's the part that should make this feel urgent. This isn't some rare skill for professional traders. It's one ratio. Once you can calculate it and read it correctly, you go from guessing at a number on a screen to actually knowing what you're buying. That's the entire gap this video closes. So let's start with the actual tool, because it's simpler than Wall Street makes it sound. When you pull up a stock online, you get flooded with numbers: the opening price, the market cap, the dividend yield. Buried in that pile is one called the P/E ratio, short for price to earnings, and it's the most common example of something called a multiple. A multiple, in plain terms, is just a ratio that compares what a stock costs to some real underlying piece of the business. Usually it's profit. The general rule, the higher the multiple, the more you're paying for that business. Okay, so here's the thing that made this click for me. Think about a butcher shop. You can't compare a $20 slab of beef to a $15 slab of beef just by looking at the price tags, because you have no idea if you're getting the same amount of meat. What you actually want is the price per pound, because that's the number that tells you the real deal, regardless of how big or small the package is. A multiple is the stock market's price per pound. It standardizes what you're paying against what you're actually getting. The most basic version of that is the trailing PE, your current share price divided by the company's actual profit per share over the last year. Let's do the math out loud. Say a company has 1 million shares out, each trading at $30, so the market values the whole company at $30 million. If that company made $2 million in profit last year, you divide 30 by 2, and you get a PE of 15. You're paying 15 times last year's profit to own a piece of this business. Except the market doesn't actually care that much about last year. It cares about next year. So investors also use the forward P/E, same math, except you divide by the profit analysts expect the company to make going forward, not what it already made. If that same company is about to launch something that pushes expected profit up to $2.5 million, the forward multiple drops to 12. Suddenly, the exact same stock looks noticeably cheaper because you're now paying for a bigger number. And here's my actual read on this. Most people treat the PE ratio like it's a single verdict: cheap or expensive, done. It isn't. It's an input. On its own, a multiple of 12 tells you almost nothing. What it's compared against is the entire game. Once you've got a multiple, the number by itself still doesn't mean anything. You have to hold it up against something. The first benchmark is the company's own history. Say a stock's 10-year average P/E is 15, but right now it's trading at 12. That gap matters. If earnings go up while the price drops, the multiple contracts. The market is suddenly willing to pay less for the same dollar of profit. If earnings go down while the price climbs, the multiple expands. People are paying more for less. Investors who watch this closely are usually betting on reversion to the mean. If a company hits a rough patch, a bad PR week, a supply chain hiccup, but the actual business underneath is still solid, that multiple tends to crawl back toward its normal range over time. You can profit off that even if the company's earnings never change, purely because the market's opinion of it corrects itself. The second benchmark is the competition. Back to the butcher shop for a second. If you find pork on sale for $6 a pound and it used to cost you $8, that feels like a win, until you notice the butcher across the street is selling the exact same cut for $2.50 a pound. Suddenly, your deal is actually a ripoff, just a smaller one than before. Same logic applies to stocks. Say your company is trading at that 12 times multiple we calculated earlier, and its two closest competitors are trading at 13 and 7, an industry average right around 10. Your company is technically cheaper than its own history, but it's still more expensive than the industry it's competing in. Both of those facts are true at the same time, and you need both benchmarks to see the full picture. One without the other is a half-finished comparison, and half-finished comparisons are how people talk themselves into bad buys. Real quick, I want to hear from you on this one, because I go back and forth on it myself. If a stock is trading above its competitors but below its own 10-year average, are you buying it or walking away? Genuinely tell me in the comments. I read these, and the replies on this specific question always seem to split about 50-50, which tells me there's no obvious right answer here. Now, a quick complication, because investing is never just one number. A higher multiple compared to your competitors is not automatically bad. Fast-growing sectors, think tech, naturally trade at higher multiples than slow, steady sectors like utility companies, and that's not the market being irrational. If a company is growing its profits dramatically faster than its peers, paying more per dollar of current profit can be completely justified because next year's profit dollar is a much bigger number. So a high multiple isn't a red flag by itself, and a low multiple isn't a green light by itself, which brings us to the part where a lot of people lose real money. I genuinely did not know this until I was 24. The year I found the Buy Now, Pay Later button at checkout. It split a purchase into 4 payments of around $50 each, felt basically free in the moment, and by the time I had a few of those stacked up at once, I was paying more every month than if I just bought the thing outright and skipped the games. The price looked smaller, the deal wasn't. Here's where I think people get burned the most, and it's the value trap. Just because a stock is cheaper than its own history and cheaper than its competitors does not automatically make it a good buy. Back to the butcher one more time. Imagine you find steak marked down to $3 a pound, an unbelievable price. So you grab it. You get home, unwrap it, and it's expired, discolored. You're not even sure it's beef anymore. The price told you nothing about the quality, and by the time you found out, you'd already paid for it. A low P/E can mean the exact same thing. Sometimes a company's multiple is low because the market has already, correctly, priced in that the business is dying. New regulations just gutted their entire business model. Consumers moved on to something else completely. Their future profits are permanently damaged, and the falling multiple isn't a bargain, it's the market pricing in a funeral. Buy a stock because the number looks small, without checking whether the underlying business is actually healthy, and you don't get a deal. You get a value trap, a stock that looks cheap and then keeps getting cheaper, because it was never actually cheap to begin with. It was just dying quietly, at a discount. Now, to be fair to the other side of this, some of you are thinking, doesn't that mean you should just avoid every stock with a falling multiple? And isn't that overly cautious? Wouldn't that mean skipping the real bargains along with the fake ones? That's a fair challenge, because that is the mistake in the other direction. Refusing every cheap-looking stock out of fear turns you into someone who never buys the real bargains either. The temporarily bruised but fine companies from the reversion example earlier. My answer is that the fix isn't avoiding low multiples. It's changing the order you check things in, which is exactly where I want to land this. Here's the actual structural problem underneath all of this. The P/E ratio runs on accounting earnings, and accounting earnings can legally be smoothed, adjusted, and shaped by a company's own management using assumptions and non-cash items that are completely within the rules. That means a multiple, even calculated correctly, is a slightly blunt tool. It's useful, it's not perfect, which is exactly why the order you use it in matters so much. If you start your search by screening for the lowest multiples you can find, you will build yourself a portfolio full of dying businesses, because dying businesses are exactly what shows up on that list. That's not a strategy. That's the value trap turned into a spreadsheet. The move that actually works is doing it backwards. Find the excellent business first. Strong operations, a clean balance sheet, real prospects ahead of it, using everything except the multiple. Only after you've confirmed the business itself is genuinely good do you pull up the multiple, and at that point, all it's telling you is whether you're overpaying for something you already know is worth owning. That's the whole difference between screening for cheap and checking for fair. Warren Buffett said it in one line decades ago. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Everything in this video is just the math behind that sentence. So go back to that price tag for a second, the one you're not supposed to trust on its own. The multiple was supposed to be the fix, the number that finally tells you what you're actually paying for. And it does, more than a fair price ever could. But half of what makes that number worth trusting hasn't happened yet. The forward multiple, the one that made our fictional stock look cheap at 12 instead of 15, was built on profit nobody has actually earned. It was an analyst's guess, sitting exactly where a fact is supposed to go. Get that guess wrong, and the cheap price tag you trusted was never cheap. It was a forecast wearing a price tag. The price tag was never really about $10 or $100. It was always about how much of that number is real and how much of it hasn't happened yet.